Now let's take our balanced and forecast three-statement pro forma model and use it to estimate equity value per share. We'll use that using the discounted cash flow method. The discounted cash flow method looks at the current value of future cash flows. So we need to do a free cash flow calculation. You're going to get deja vu from doing the statement of cash flows because it's very similar. We're going to start with net income, subtract off the operating activities and the investing activities that are associated with our business, which in this model is all of them. But we are not going to subtract off any cash flows from financing activities. In fact, we are going to add back the after-tax interest on debt, which was already a financing activity included on our income statement. And we're going to subtract the interest that we earned on cash. So let's go ahead and do that again. We could take the net income from this statement, but I think it's a better review to go ahead and take it from the income statement. We'll start with net income, and then the next thing we'll do is add back depreciation. So let's get both of those lines while we're up there to minimize the scrolling. So if I start with net income, the next thing I'm going to want to do is add back F20. So equals minus F20. And then we'll subtract off the increase in current assets, excluding cash. And we will add back the increase in current liabilities, excluding debt. Subtract off the increase in fixed assets at cost. That was our gross PP&E. And then we'll subtract off the increase in other non-current assets. We're assuming that that represents investments in operational items and not in financial type investments. We will add the increase in other non-current liabilities. And now we need to get the after-tax interest on debt. First, we need a tax rate. So I'm going to come down here and take a step ahead and say our corporate tax rate. For this, we want to use the first driver for the best estimate of future conditions. In other words, if historically our tax rate were 21%, but we think going forward it we're going to be higher than that, here we'd probably want to use a higher rate, which we calculated already as a ratio from our income statement when we looked at the effective tax rate. Now right now we're forecasting it as 21, but if we change that, we want it to change the items below. So I'm going to use column F instead of column E, and since it's negative, I'm going to put a negative sign in front of it so that our tax rate is 21%. So to get after-tax interest on the debt, I'm going to take the interest on the debt, the interest expense times 1 minus that tax rate. And I think I need a sign change. Since this is an outflow, but I want to add it back in, I'm going to put a sign change in there. And then similarly, the after-tax interest on cash, since it's going to be an inflow and I want it to show as an outflow, I'll use a negative sign. Times the interest income times 1 minus the tax rate. So this is going to look very similar to the statement of cash flows. The first several lines should be the same, so let's check them. 106, 42.8, 6.1 negative, 2.7, 100, and 2.4, all with the same signs. Might even have one more on here, the 1.9. So all those matched. That's a good double check for us. And then we went ahead and made our interest adjustment. So this is the free cash flow to the enterprise, both debt and equity. So, oops, not a good way to copy that because it picked up this line. So I will copy and paste special formulas. There we go. So that's our free cash flow that represents what the value of the firm is worth. However, it's not going to stop right here. It's going to continue going. So one thing we'll do, I'll jump down and do it next. We want to calculate a terminal value. And that represents all the future cash flow that the firm would ever generate. There are a couple of ways we might estimate that. One is using the perpetuity growth method. And that says it's just going to grow forever at some rate, a long-term free cash flow growth rate. And my note here says that should be pretty close to our forecast of long-term gross domestic product growth or inflation. And so that's usually going to be around 2 or 3% depending on your economic outlook. And so we'll start with that. And what this note says is take the terminal value, to get the terminal value in time t, which is the terminal year, or in our case 2024, take the free cash flow in that year, multiply it by 1 times the growth rate, and divide it by WACC minus the growth rate. So let's take the free cash flow in that year times 1 plus the growth rate, divided by WACC, which we'll calculate in a moment, minus the growth rate. The other way to get a representation of this cash, or all this future cash flow, is to just use a multiples method. And this would be like valuing a stock based on a multiple of their cash flow, for example. So we'll just take that last year of cash flow and multiply it by the exit multiple. These numbers aren't very comparable until we get WACC in there. So let's think about WACC. WACC is the weighted average cost of capital. It says take the after-tax cost of debt times debt plus the cost of equity times equity and divide by debt plus equity. We have a couple of those already. We've got tax rate and we were given the cost of equity. We could go out and use the capital asset pricing model for that, but it's not super reliable and it's not really in the scope of this video, so we're just going to enter 20% right now. What we do need is cost of debt. And so much like the tax rate, we want to use the first driver up there just in case our forecast suggests that the cost of debt is going to be different than history. So let's say equals, and since I think we shortcutted it and used it as a negative, I'm going to put a negative sign just like we did on the tax rate. Yeah, we represented it as a negative to facilitate our income statement forecast. So we'll use a negative times that. Negative 5 gives us a 5% cost of debt. Now debt we can go 2 places for. We could go to the book value and pull it off of the balance sheet, or we can go out to the market value and see what our company's see what our company's debt is trading for and how it's discounted by investors. Let's just grab this one off of the last year of our history. So we use the book value of the last year as our best estimate of debt. And then we have one left to get, and this is equity. Now I don't trust the book value of equity here, so I'd like to use the current market value. And so I think the best estimate of that is our diluted shares times our share price. And so we'll take the diluted shares in the bottom of the income statement times the share price. And what it says is we're capitalized more with equity than with debt, based on using a book number here and a market number here. And so remember that formula for WACC. It was equals 1 minus the tax rate times the cost of debt times the amount of debt plus the cost of equity times, if I click right here, it's going to edit my formula, so I'm going to click right here and go down 1 to get the amount of equity. I'm going to divide all of that by the amount of debt plus the amount of equity, and see that my weighted average cost of capital is about 14%. I think we did something wrong in that cell. Looks like I forgot to put absolute signs on these two. So where I'm saying 1 minus the tax rate, absolute, 1 minus the tax rate, absolute. That would have made an interesting effect on our future cash flows. Okay, so then let's come down and say our perpetual growth terminal value using the perpetual growth method is about 1.7 billion, and our multiples method is about 1.9 billion. So look at all the work we did above line 124 to get $100 or $200 million a year in cash flow. And then look at the short amount of work we did to extend that throughout the rest of eternity to get $1.8 or $9 billion in cash flow. Now granted, that's not discounted back to time zero. It's really reflected here in the last year. So we need to discount that back to time zero here in a moment. But first, let's see how good are these numbers anyway. If I calculated this number using the perpetual growth method, what exit multiple would I have had to use to get the same answer? So I can take that number and divide it by the last cash flow. I would have had to use a 9.1 multiple instead of a 10. That's actually not too bad. What would I have had to do over here what long-term growth rate, what implied growth rate would I have had to use to get the same answer out of the other method? And so to do that, I need WACC times this terminal value divided by the free cash flow minus 1 divided by 1 plus the terminal value over the free cash flow. I don't think I can remember that in my head, so I'm going to hit Shift F2. I'm going to copy this text and come down here and hit F2 and paste. And then I just have to double click that, choose WACC, double click that, choose the terminal value, double click that, choose the last free cash flow, double click that, choose the terminal value, and double click that and choose the last free cash flow. Far better than me trying to remember that formula in my head. It says I would have had to have a long-term growth rate more like 4% to end up with this same. And let's test that. If I had put 3.98 over here, let's see if it moves this number to 18961. So 3.98 gives me the same number here. So that's what we mean by these implied multiples. I'll undo that and say if I had used a 9.1 multiple over here, then this method would have given me about the same. There's some rounding there, but you get the idea. So I'll undo that. And so if we believe in these inputs and the equity assumption that we made, everything else comes originally from our income statement and cash flows. So we said that these cash flows are worth less to us today than they are in the future. So we need to discount numbers like that back to, in fact, the end of this year. So this needs to get discounted a full amount, 1 full year, 2 full years, 3 full years, 4 full years, perhaps. We'll come back to this cell in a moment. So that would be, say, take the NPV at some discount rate, which is going to be WACC, and then discount these cash flows. Now, normally when we're using NPV, we would have something right in front of it, right? We'd have the investment in time zero that it took for us to get those cash flows. But since we're not making an investment to get these cash flows, we're presuming we already own the firm and just want to know what it's worth, we can use NPV just like it's written. And that tells us that these cash flows are worth $430 million today. Now there was an assumption we were asked to make, and that says that the cash flows were in the middle of the year. So we really didn't make that $190 million. We didn't realize that at the very end of the year. We realized it across the year. So each of these need to be inflated by 6 months. You need to get 6 months larger. And one easy way to do that is just say multiply the whole thing by 1 plus WACC to the power of the periods. And the periods is only half a period. So instead of 430, it's 460. Let's do the same thing here. In fact, I can copy that whole thing. With Control A would have been good. And come over here and paste it. And it's the same exact thing. The other thing I could have done is referred to it from over here. It's the same in both methods because these cash flows are the same in both methods. But this one's not. This is where we take that terminal value and divide it by 1 plus the WACC to the power of the number of periods. Well, how many periods am I discounting this? I told you this occurred at the end of 2024, so it needs to come back 1, 2, 3, 4 periods, but not quite 4 periods because we want to inflate it also by half a year. So I'm going to use a formula to get it. This minus this gets me those 4 periods, but I don't want the whole 4 periods, so I'm going to do half a period less than that. So stop and think through that math, why we did this minus 0.5. It's going to feel to you like we should do a positive 0.5, but think through it. And remember that we were dividing by this time value factor here where we multiplied by it here, and maybe that will help. So we want to copy that over here as well. We want everything to be absolute except the blue cell. So we'll do it that way, copy, paste, and see if it worked. So now we're discounting this terminal value at WACC for that many years minus half a period. Now we want to add them together. And this is the enterprise value, which is the present value of all those future cash flows. We calculated that 2 cells above. And the terminal value, we calculated that 1 cell above. So we just need to add these 2 cells together and copy that. And copy that over here. Now, this is what the value of the future cash flows forever are. We have some cash on the balance sheet, so that adds to our value as an equity holder. I'm going to grab that cash that we had at the end of this year, which is when we're valuing the firm as the end of this year. And then we had some debt, so we're going to have to pay that off. So let's say show that as a negative. So if we use our cash and pay off our debt and add that to the value of all the future cash flows, we get what the equity value is worth to us today. So it's those 3 summed together. And that's something I can copy and paste as well. These need to be the same as those. Of course, it's the same cash and debt regardless of which method we're using. So I'll just refer to them here. And then finally, we want to divide that by a share count so we can get our value per share. Well, now that we're selling the firm, hypothetically, all these convertible shares up here, whether they were securities or options or what have you, they're going to get exercised. And so we're going to be diluted from the 62.4 to the 63.7. So I'll put that as a absolute reference so I can copy and paste it here. And then our dollars per share are 24 using one method and 26 using the other. Let's see how that compares to history. Not too bad. Looks like it's about 20% higher than the current share price, which surprisingly is really common among these kind of evaluations because we're not accounting for much risk here. We're just assuming the future goes on. And investors sometimes put more risk on that, allow more upside in their investment. So we have calculated a share price using 2 methods. We could average those together, put it on our dashboard as the best method. And in the next video, we'll do some ratios. Thanks for watching.